Hi, this is Ben Parojcic with Remax Above and Beyond, and welcome to your Real Estate Market Minute. Well, today I wanted to talk to you about how to save up down payment money even if you have credit card debt. A few weeks ago, I did a video about managing your credit and increasing your credit score. This is kind of a part two to that. Um, so the good news is if you want to buy a house in 12 to 18 months, but you do have credit card debt and low savings, there are things you can do now to put yourself in a position to be able to buy a year from now. Um, it's really pretty simple, but it's not easy. It does take some sacrifice and it does take some discipline, but you can do it. The first thing to do is get clear on your goals. Like, what is the amount of money you need in order to buy a house? And I think the simplest way to do that, or to figure that out, is to go to a loan officer and get a pre-qualification. Maybe you're not ready for a full pre-approval yet, but a pre-qualification, that loan officer can tell you how much house you can afford based on your income. And when you get that number, let's say it's 200,000, you can apply the down payment percent requirement. Um, Most people think they have to put 10 or 20% down. It's not true. You can do as little as 3.5% for FHA or 5% as conventional. Let's say you're going a conventional loan, 5% of 200,000 is 10,000 down. That is your savings goal, and that is what you're going to start to work toward. You also simultaneously need to start getting those credit card balances eliminated or lowered. So there's a way to do this. I call it the bucket method. In bucket number one, you're going to take your extra money at the end of the month and put 70% of that money in bucket one, which is debt reduction bucket. Bucket two is house savings account bucket. Now, the debt reduction bucket, you're going to take the lion's share of that money and apply it to your highest interest rate credit card. The rest of the money you're going to use to pay minimum credits or minimum payments on the rest of your credit cards. In so doing, you are going to bring down the balance of your high interest rate credit card the fastest and pay that off the fastest. And you're going to save yourself the most interest that way. When that credit card is paid off, you're going to move on to the next highest interest rate credit card and allocate as much money as you can to that credit card while still being able to make the minimum payments on the other credit cards. Now, during the same time, you're going to take the money in bucket number two and put 30% into your high yield savings account earmarked just for your house. You're not going to take that money out to go on vacation, to buy a car. It's just for the house. And as you do this, you're going to see your savings account grow, and you're going to see your credit card balances come down. So it's incredibly motivating seeing that happen, and it's going to keep you engaged and motivated and kind of inspired to keep doing this to get those credit cards paid off. Once you have the desired amount of money in that account, and maybe you've paid off one or two of the credit cards, you'll be in a very good position to get that pre-approval. Paying down or paying off the credit cards is going to increase your credit score. And it's also going to lower your debt to income ratio, which means more of your income will be able to flow to the house. You'll be able to afford more house. Quite possibly, the better credit score will get you a lower interest rate and also maybe save you on your property insurance. So there's a lot of benefits to doing it this way. If you would like to get started and you need to know what that savings goal should be, give me a call. I'm happy to give you a recommendation to a loan officer so you can get pre-qualified and figure out what that down payment amount is. And that's your real estate market in a minute. I hope you enjoyed it. If you did, remember to like, share, and subscribe.